Hello everyone, welcome back to RoyalT Empire Education. And for those who don't know me, my name is Tyrone. We are in a series talking about option trading. We have covered both long call and put. If you have not seen those two videos, you can go check it out on our YouTube channel and it will be listed there for you. Long call and put is all about buying an option contract. As I said in my intro video of option trading, there are two kinds of traders in the market. There are the buyers and the sellers. Since we know how to buy a call and put options, we will discuss the selling aspect of it. This is what we call the short call and the short put. Today we will talk about what is a short put and how it works. What is a short put? Instead of buying an option, you are going to sell it. A short put means that you are selling a put option at a certain strike price and hope that it will never go below that price so you can make money. This type of option has limited gain and an unlimited loss. All you need is an amount cash available to sell an option. This means that whenever you sell an option contract, you don't spend any money. You just have the contract till expiration. When your contract has not been exercised, then you would keep the premium that you sold. These short contracts are a little bit more confusing than the long contracts because you don't have to buy anything, but you have to sell it. This doesn't make sense, right? How can you sell something that you do not own? Well, in option trading, short call doesn't mean you're actually selling something. It is actually an agreement that you have with the buyer that if it hits the strike price, then you as a seller will have to sell it at that price. So if you decide to choose the short put option, then you are hoping that the price will not go below the strike price. To explain it better, I will give you an example. Let's say that company B's current share price is at $270. With the help of patterns and the news of the economy, you project that the stock will go up. Instead of buying a call option, which would require you to buy 100 shares if you exercise it, you can sell a put option. All you have to do is find the price that you are certain it will not go under. The strike price is $250 and the premium of selling that contract is $3, which you would multiply it to 100, getting $300. If the expiration date is in 30 days and the price has not dropped below $250, then your contract would expire worthless. This means that you get to keep the $300 that you sold for the contract. If your option does go below $250 within 30 days, your loss would be dependent on what price does the buyer decide to exercise their option. In this scenario, the price of the stock goes down to $240. If the buyer exercises their option, then you are forced to buy 100 shares of stock B at that price of $250 per share and resell it to the buyer for $240. If you multiply it by 100, you would spend $25,000 and resell it for $24,000. So your total loss would be $1,000. This option contract sounds bad because you have a limited gain and an unlimited loss. While that is true about this contract, you can also lower your risk by setting up alarms on when to buy back an option so you don't have to be obligated to sell it. This contract is very good for people who has a lot of money in their portfolio and are willing to take risk to make a constant income. Today we covered about what is short put and how it works. All you have to do is make sure that the strike price you choose is a solid price and then you know that it will not go under it. This means you have to put in the study and be confident on what is going to happen in the future. Be sure to be ready for any scenario in order to minimize your risk and loss in this trade. Subscribe and like to learn more about stocks and investing. And if you have any questions, comment down below and I will gladly answer them for you.